Thank you for hopping on to our fixed index annuities training. We appreciate everyone that was able to join us today. We have Chris Bailey from Nationwide with us, and I'm going to let you take it away, Chris. Thanks so much for joining us.
Perfect. Thank you, Kelly. I first want to also thank everybody out there for taking the time to come learn about a fairly new product in the market and a fairly new product for CAFL as well, called the Nationwide Peak 10 Fixed Index Annuity. Before I get started, I do want to, first of all, thank CAFL. CAFL's been a very long partner and relationship that we worked with at Nationwide, not only on the life and long-term care side, but CAFL is also one of our largest distributors of our income, our SPIA product, our immediate annuity, as well as our MIGA called Secure Growth. So just want to thank you guys, and thank you to any agents or producers or advisors out there that have sold or positioned any of our fixed annuities through CAFL. And I am excited to kind of go through the Peak 10 product, which is, again, a fairly new fixed index annuity in the market. It's been around for a little over 3 years, and CAFL got access to it almost 6 months ago or so. And CAFL is, this is a product that's pretty limited distribution. It was built as a proprietary product for the Icon relationship. So CAFL, being part of Icon, has kind of exclusive access to this product from Nationwide. And I was part of the design behind the product. And I'm really looking forward to going through that today. But just a little bit of my background. So I've been with Nationwide for 18 years. The majority of my career at Nationwide has been really focused on kind of that BGA, IMO, FMO, whatever acronym you want to use, distribution. I really came up on the life and long-term care side and then moved over to the annuity side in 2018 to really help build kind of this IMO annuity distribution for Nationwide. And I know, I work with a lot of folks over at CAFL. My internal Ursula works with them as well. Peter Skelton, the team over there, do great things for the agents and producers they work with. So you're in great hands at CAFL. And you also get access to this proprietary product from Nationwide. But I want to just review the agenda. I do want to start with kind of why Nationwide, talk about the strength and stability of Nationwide. I don't need to spend a lot of time there because you're all familiar with the brand, right? I mean, if I were to walk into a room of 50 people and say Nationwide, everybody's going to say the same 4 words in the same kind of harmony is on your side. But there's a lot of things that Nationwide does and things that we stand for that you may not be fully familiar with. And I think it's important to start there to give you at least a high-level overview and a high-level understanding of the carrier that you're positioning the clients that you work with every single day. And then I want to jump into the Peak 10 product, talk about features, positioning, where it's positioned for both accumulation and guaranteed income. Go over some sales ideas that you can have a lot of success with when using the Peak 10 product. And then I want to close out talking about the Nationwide Healthcare Cost Assessment Tool. This is a free resource for you and your clients to help with the conversation around healthcare costs in retirement. This is all administered through a team here at Nationwide called the Nationwide Retirement Institute. They've really got 7 core programs, but I'm going to dive into the healthcare cost assessment tool in more detail because I think it really does a good job of kind of positioning an annuity sale and opening clients' eyes up to the second largest cost in retirement after a mortgage, but is a lot of times most forgotten. And I think it really does a good job of kind of positioning that annuity sale to help cover those out-of-pocket healthcare costs. And I'll try to finish up about 2:45 to give some time for questions and comments and see if there's anything I can answer. Okay. So first and foremost, why Nationwide? Why you as advisors would want to work with a carrier like Nationwide. And I think if there's one thing you take from really the next 5-10 minutes, as I talk about the enterprise that is Nationwide, is the fact that Nationwide is a full mutual insurance company. Okay. We are not publicly traded. We are not a stock company. Okay. And that really gives us a huge advantage because really every decision that we make at Nationwide, we have our members, right, which is how we refer to our policy holders, at the forefront of our brains as we're making those decisions. And I mentioned earlier, I've been with Nationwide for 18 years. as I go through this, I'll share some kind of fun facts about Nationwide as an enterprise. And first and foremost, we were founded as a mutual insurance company nearly 100 years ago. We're going to be 100 years old in 2026. And we were founded here in rural Ohio. I live in Columbus, Ohio, well, suburb of Columbus. And we were founded in Ohio by a group of farmers actually to provide low-cost property and casualty insurance to the farming and ranching community. And we still hold those values with us today. We're still a full mutual. And that's a huge advantage for us. And when you look at our ratings, A+ rated across the board. But the rating I always like to focus on is our rating with AM Best. And the reason I do that is because AM Best actually takes into account the claims paying ability of the insurance company when they're giving out and renewing their ratings. And because we're a mutual, right, we want to make sure that we can satisfy those claims and keep those promises that we made to every single one of your clients. And when, I think there's really two main reasons why Nationwide is so strong and stable. I think first and foremost, it's that conservative investment strategy of Nationwide, but more importantly, it's the broad diversification of Nationwide. And when you think of Nationwide, you hear the jingle, you see Peyton Manning, you see Brad Paisley, all the commercials, right? Most people think of property and casualty insurance. That's how we were founded nearly 100 years ago. Real quick, fun fact on the PNC, on the property and casualty side. Did you know Nationwide is actually the #1 carrier in the United States for pet insurance with about a 45% market share? So, and it was funny. I was actually in a meeting with our pet insurance sales team because I had a BGA trying to wholesale our pet insurance, which we couldn't do. But during that meeting, the sales team on the pet insurance side of Nationwide actually let me know that the first pet we ever insured was actually Lassie. So we've been in that business for that long. Lassie was on what, 60s? So we've been in that business for that long. And I just found it very interesting that we have all that deep history on the property and casualty side. But then when you look at the financial services business, we really have four main lines. We have obviously annuities. This is what we're focused on today. We have life and long-term care products. We have 401k plans or retirement plans. And we have mutual funds. And Nationwide is a top 10 carrier in all of those four lines of business. But when you look at the annuity business specifically, I think it really, Nationwide sets itself apart because we diversify there as well. I mean, we're a top 10 carrier for fixed index annuities, top 10 carrier for variable annuities, top 10 carrier for SPIA and MIGAs, as well as fee-based annuities. And when market dictates fixed and fixed index being kind of where clients are going, we can pivot to that side pretty quickly. And then vice versa. If the variable annuity market is kind of blowing up and we need to pivot over to the variable annuity side, we can do that. And a lot of carriers can't say that, right? When you hear the names like Jackson National, everybody thinks of variable annuities. When you hear the big players in the fixed and fixed index market, Athene, F&G, Global Atlantic, Allianz, right? American Equity. They're kind of pigeonholed into those one type of annuity. Nationwide's had record years the last 4 years on the annuity side, and it's because of our broad diversification. So, I could go on and on about Nationwide as a carrier. Couldn't be prouder to work for a carrier like Nationwide, but I would like to move on to the Peak 10 product. Again, this is a proprietary product for CAFL. And the Icon entities or the Icon BGAs. There's very few BGAs out in the market that have access to this product from a carrier like Nationwide. And when we talk about Peak 10, what your clients can expect to get from this product, first and foremost, is protection from market risk. Mr. or Mrs. Client, you cannot lose premium inside of this product, but still have the ability to earn some pretty substantial growth based on the index or index strategies they may choose to allocate to. So there's 5 indexes inside of Peak 10, and I'll go through more of them as I share the rate sheet here in a few slides. Real quick, I'm going to jump over the third image there, and just let you know from a guaranteed income perspective, there's 2 options on Peak 10 when we think about guaranteed income. I'll go through both of them in a lot more detail. But back to that third image where it says protection for a spouse. I'm going to cover this now because it is a huge differentiator for not only Peak 10, but every single annuity product at Nationwide. Okay. And this is referring to a built-in feature on all of our annuity contracts called spousal protection. Okay. And I'll go through what it does and kind of the mechanics of it. But the reason we can offer this at Nationwide is because Peak 10, as well as all of our annuity contracts, are annuitant driven contracts. They are not owner driven. Okay. So because we're annuitant driven, we can offer this spousal protection feature. You'll also hear it referred to as the joint death benefit option. But with spousal protection, what Nationwide will do is if there is a spouse in the picture, okay, we will automatically add that spouse as the co-annuitant at no cost, even on qualified money. Let me repeat that. With spousal protection, what Nationwide will do is if there is a spouse in the picture, okay, we will automatically add that spouse as the co-annuitant at no cost, even on qualified money, leaving that surviving spouse. So when, let's say, one spouse passes away, it leaves that surviving spouse with some flexibility. They can either continue the contract on themselves or collect the death benefit and move on. So let's walk through a real quick example of this. Let's say you have a husband, wife. Let's say wife has $200,000 of qualified money sitting in an IRA, okay? She decides to take that $200,000 of qualified asset that's in her name, right? She's the owner. We can only have single ownership on qualified money. She decides that she wants to move into Peak 10. Let's say pure accumulation. Let's take income out of it for now, okay? So she takes that $200,000, submits an application to Nationwide. She's on there as the owner, obviously. She's on there as the annuitant. If her husband, she doesn't have to put him on there as a joint or co-annuitant, but if he is on there as a beneficiary, identified as a spouse, Nationwide will automatically add him as that co-annuitant. We don't even tell anybody because there's no downside to the owner. Okay. And it's funny. I've actually had advisors and agents get to me through a BGA that I work with, and they're like, we got the contract in the mail. What the heck did Nationwide do? They added the spouse as the co or joint annuitant. We didn't pay for this. We did not want this. But then when we explain the benefits of this, they love the feature. So let's go back to that example. Again, husband, wife has $200,000 of qualified money, moves it into Peak 10, pure accumulation. That contract goes to issue. Her husband was on there as a beneficiary. We automatically add him as that co-annuitant. So now let's fast forward 7 years later. It's now June of 2031. Okay. If husband dies, remember, she's the owner. She's the primary annuitant. He's the joint annuitant. If he dies first, predeceases his wife, she now has the ability to either just keep the contract going, which, every contract does. But where it differentiates itself is when he dies, she now has the ability or flexibility to collect the full death benefit on her own IRA. All surrender charges are waived. Remember, 10-year product, passes away in year 7. All surrender charges are waived. Full death benefit can be paid out to her. Taxes would be owed as, qualified money is taxed, right? But it's a huge benefit. And let's kind of take this example further. Let's say when husband dies, she has lost his Social Security, lost his pension, has experienced a loss of income upon his death. She can now collect that death benefit, move in to a new product, new contract, like a Peak 10 with a guaranteed income rider to now supplement the loss of income she experienced when her husband passed away. So this is a huge differentiator for Nationwide, especially on the Peak 10 product. Okay, it just adds that additional layer of flexibility upon either spouse's death. Okay, so who is Peak 10 designed for? So this is going to be a more conservative client, someone looking for that principal protection, but still have some more upside than your, like a MIGA where there's really no upside. It's a set rate, right? So someone looking for that kind of zero is your hero. You can't lose money inside of this product, but still have the ability to earn some pretty substantial growth based on the index or indexes they may choose to allocate to. I would think 50, 55 and older is kind of the target demographic or age. I do want to jump down to bullet point number 4. I don't think I need to go through these one by one, but kind of jumping down to the 4th bullet there around someone who is retiring or close to retirement that has money inside of a 401k that doesn't necessarily need to touch that 401k at this point. I kind of refer to this as that kind of lazy 401k money. This kind of type of client is actually top of mind for me. So my dad, he retired from IBM in October of 2020. So spent 40-year career at IBM, retired at age 63 in October of 2020. And when he retired after that 40-year career, he had a very large sum of money inside of that retirement plan. I mean, he's maxing it out nearly 30 plus years. But when he retired, he had turned on Social Security. He's over 62, and he's collecting a pension from IBM, which is nice to have nowadays, right? But so he didn't and still doesn't need to touch that 401k. So since retiring in October of 2020, nearly 4 years ago, he has purchased 2 separate Peak 10 contracts where he took some of that asset inside of that 401k, moved it into Peak 10, where he added the joint income rider to now guarantee an income stream for not only his life, but also my mom should he predecease her. So just to give you an idea of a typical client you'd be looking for, again, kind of that lazy 401k money is kind of how I refer to it. But just a few high-level product details. I'll go through this quickly. So this is a single premium product. This is not flexible premium. Once the contract issues, no subsequent payments can be accepted. It is a $25,000 minimum premium. Another differentiator for Peak 10 is around our max issue age. We'll actually go up to age 85 on the annuitant. Most index annuities out there go up to about age 80. So we can go up 5 years longer. Different plan types we will accept, from non-qualified to all those different types of qualified plans. As far as the surrender charge schedule, again, this is a 10-year product. So you can see the surrender charge schedule there. To give clients some added flexibility as far as penalty-free withdrawals, we actually allow up to 10% penalty-free starting in year 1. So as early as day 30 of the contract, the client has access to up to 10% penalty-free. There is a long-term care and terminal illness waiver on this product. Basically, what that's referring to, it's not an LTC doubler like you see with some of these income riders on index annuities. Basically, should a client be confined to a long-term care facility or diagnosed with a terminal illness, surrender charges get waived. Okay. As far as the indexed options, these are the 5 indexes that clients can choose to allocate to. The 2 on the right, you're probably familiar with, the S&P 500 options. The one on the far right is basically a volatility controlled version of the S&P. But the 3 on the left is what 95% of the allocation is going to. You've got our indexes with AllianceBernstein, Growth and Value Balanced, and the JP Morgan Cycle Index. Those are the 2 vol controlled indexes we launched with in January of 2021. And then in May of 2022, we rolled out our newest index with BNP Paribas called the Global H Factor Index. Okay. When we launched this really catapulted Peak 10 to the forefront for not only accumulation, but also like what I refer to in the income space as income plus accumulation. Because this BNP index, of the 95% going to these 3 indexes, 70% of that is going to BNP. And you'll see it when I flip over the next slide as far as the rates that we give on this index. It's substantial, and it illustrates very, very well. But I am also proud to say it's also performing very, very well. And I'll share a slide from a third party that shows the year-to-date performance on this H Factor Index, as well as the rolling 12-month performance. And then when you see the participation rates on an uncapped option that you're going to get with this index, it's substantial what clients are being credited right now using that Global H Factor Index with BNP. Okay. But here's the current rate sheet. So we did hold rates in July. So this is still true. What you'll see here, if you don't see your state up here, Paffel, I know you're in New York. Unfortunately, Peak 10 is not in New York. But it is in every state but New York, California, and Delaware. Okay. So what you're seeing here is the non-compact rate sheet. So if this really gets into state filings, you've got compact states, non-compact states. Basically, some of the compact states are like Pennsylvania, Ohio, which is where I live, Texas, New Jersey, Illinois. I'm sorry, Illinois here, but basically some of these states came together and created the insurance compact that require carriers to start with a lower starting surrender charge percentage. So basically how we pay for that is it's a little lower rates in like states like Pennsylvania and Ohio and Texas. Okay. But just for example purposes, let's run through the non-compact rate sheet just so you understand what clients have the ability to allocate to. So on the left-hand side, clients can choose to allocate to a 1-year capped option. So the thing of this is your annual point-to-point with a cap. Okay, you can see what current caps are. You know, the S&P 500, current cap's 8%, which is extremely high on an income product. Okay. And then we have a fixed rate of 4.55%. I like allocating a portion to that fixed rate to guarantee at least, in this example, 4.5% on a portion of the allocation or a portion of the money. I also like to use that as kind of an alternative to a MYGA. You know, allocate 50%, 75% to that fixed rate, put the rest in an uncapped option, should outperform what you're getting on a MYGA right now. Granted, it's a 10-year product versus a 5 or 7, but you know, you should have higher returns by allocating a portion of that fixed and then some to the uncapped options. As far as the uncapped strategies for Peak 10, there's 2 options. You have option A, option B. These are 2-year strategies. So when we look back at the capped, it's 1 year, annual point to point. The uncapped options are 2-year point to points. Okay. And we have option A and option B. Think of these as just spread or no spread option. Option A, you can see there's a 1% spread. Option B, no spread. Let's walk through an example, though, really quick of how and when the par rate and the spread are applied if there is a spread, okay? So let's say a client allocates 100% to the index with BNP, option A. So we can see that the client's getting a 340% participation rate with a 1% spread. Okay, so let's just, example purposes, 100% of the allocation went to that index with BNP on option A. And for example purposes, let's say after that 2-year period, the index does 10% from a raw return. Let's make the math easy for me. We will actually first apply the par rate of 340%, bumping us up to 34. We then back off the 1% spread, crediting 33% of the client's contract value, which is more beneficial to the client, right? As opposed to applying the spread first and then applying participation rate. Same example. Let's say a client did, you know, the index did 10%. If we were to back off the 1% spread first, we'd be applying at 340 par to a 9% return, crediting 30.6 versus the 33, right? So again, speaks to that mutual carry that Nationwide is. You know, I do want to ask if you've sold fixed index annuities in the past or are currently selling them. I like to ask a very rhetorical question. Have you ever been burned by renewal rates from a carrier as far as what happens at renewal once that strategy matures? If we're in person, I'd say 90% of you, if not 100%, would raise your hands. Okay. But I do want to touch on the renewal rate integrity of Nationwide when we specifically talk about Peak 10, but also more globally across all of our fixed index annuities, which there's 5 in the market, 3 of which are really dedicated to the broker-dealer space. We do have one other index annuity out there in the IMO world. But when we look at Peak 10 first, so again, this product launched in January 2021. Since the product launched, we have renewed at or above what the client initially purchased 100% of the time. Okay. I'm actually seeing renewal rate notices go out now. My own father's, right? I mentioned he's purchased a Peak 10. When he bought the product in 2022, February of 2022, he allocated a portion to the S&P cap. When he bought it, he had a cap of 5%. He got his renewal rate notice in 2023. We actually offered him a 5.5% cap. So we're actually offering clients higher rates at the renewal than what they bought 1 or 2 years prior, which is unheard of in the market. And I mean, I hear stories all the time of carriers absolutely burning clients and the producers on renewal rates. I heard a story the other day where a client bought a 2-year strategy with a spread. So it was a 2-year uncapped strategy. Think like we've got on option A for peak 10, right? Where we've got, in this case, a 340 spread with a 340 par rate with a 1% spread. When the client bought the 2-year strategy in March of 2022, okay, it had a 0.5% spread. So 50 basis point spread. Okay. 2 years later, that strategy matured in March of 2024, this year. And that carrier bumped that spread up from 0.5 to 6%. So now the client's having to hurdle a 6% spread to see any credits to contract value. Again, peak 10 renewed at or above 100% of the time. And, I know it's a small history there, and it's only been a rising interest rate environment, so more advantageous for carriers to price fixed index annuities. But we launched our very first, so globally across all of Nationwide Annuities, which we launched our very first fixed index annuity in 2014. So we just passed our 10-year anniversary of the launch of our first fixed index annuity. And globally across all of our products, we have renewed at or above 98% of the time. 98% of the time across all of our products, clients got at or above what they initially purchased 1 or 2 years prior. When we look at P10 specifically, 100% of the time. So just know that by working with a mutual carrier like Nationwide, you can avoid those tough conversations and the really tough conversations with clients as these strategies start maturing. So I wanted to share this really quick. So this is our index with BNP Paribas, that global H factor index. I mentioned 75% of the allocation is going to that index because it illustrates really, really well, right? But it is actually performing very well. So when you look at year-to-date performance, year-to-date in 2024, as of July 5th, so this was the most, I get a weekly performance email from BNP Paribas, sitting at 5.7% from a raw return year-to-date. When we look at a rolling 12 months, it's up 9.1% from a raw return. And when you apply a 340% par rate to a 9% return, I mean, clients are being allocated, being credited, 20, 25, 27% right now. So just know that this index is actually performing. And when you look at, I don't know if you subscribe to Salt Financial, it's a third-party report, but what they do is they stack up vol-controlled indexes inside of fixed index annuities in the market. BNP Paribas, this H factor index, is the #3 performing index in the market. And you and your clients can get access to it inside of Peak 10. So it's a proprietary, it's limited it's exclusive to the Peak 10 product. Okay. So just keep that in mind. It's actually performing. Real quick from an accumulation perspective, and as I share these illustrations, I will tell you I did diversify here, and I'll give you, if I put everything in BNP, these numbers would be a lot higher. But I did put 25% in that fixed rate at 4.5%. I put 25% in the S&P cap, and then I put the remaining 50% in that index with BNP. Okay. So when we look at just at a straight accumulation illustration, we've got a 65-year-old puts 100,000 in. At age 75, what does contract value look like? Grew to $298,000. Okay. If I put 100% in BNP, this 298 would actually be around 450 grand. So dial the illustrations back, because if you're showing a 18, 19% average rate of return, what are the clients going to expect to get after 10 years? 18, 19, 20%, right? So dial those illustrations back. Nationwide doesn't want to, you as a producer don't want to end up on the cover of, in Wall Street Journal of, inflating these illustrations. Okay. But now let's look at guaranteed income. So I mentioned in the beginning, there are two options on Peak 10 when we think about guaranteed income. One's actually built into the product at no cost, and that's the guaranteed income solution. And then we have the bonus income plus rider. Okay, so I'll go through both of them in more detail. First and foremost with the guaranteed income solution, it's built into the contract at no cost. So anybody over age 50 gets this built in for free. Okay. And I'll go through what it gives clients from like a guaranteed roll-up perspective on like that income benefit base, as well as payout factors and what that income stream would look like. But I think it's really being positioned one of two ways. First and foremost, it's being positioned as kind of additive to accumulation, right? Because, and I'll ask another rhetorical question. Do clients' needs and objectives ever change in retirement? If we were in person, that usually gets a laugh, right? Yeah, they always change, right? Well, this is giving a client the flexibility to turn on a guaranteed income stream and not have to pay for it, okay? But it's also being positioned as a no-cost performance-based income solution. I'll show you why and how here in a second. And then we have the rider, the bonus income plus rider. 85 to 90% of the business is coming in with this rider. I think it's just where the market is. People want those guarantees based, with all the volatility in the market, looking for those guarantees. Before I move on, both of these options, clients do have the ability to turn on income immediately. So within the first year, as early as day 30 of the contract, clients can trigger these two different income options. Okay. But with the free option first, the guaranteed income solution, what clients are going to get here is a guaranteed 4% roll up on their income benefit base at no cost for 10 years. So contractually guaranteed, if a client puts in $100,000, they are guaranteed to see that income benefit base grow to at least $140,000. Okay. But I mentioned on the prior slide, folks are using this as a no-cost performance-based income solution. And why that is what Nationwide does with both the free option as well as the rider, which you'll see here in a second. We will actually compare contract value based on the performance of the indexes to that guaranteed roll-up amount. Whichever is higher is what we will use for that income benefit base, even after income is turned on. So let's use this chart as an example. Let's say client puts 100,000 in. They wait. Let's say in year 7, this client wants to trigger the income stream from this built-in no-cost option. So we can see this dotted line is representing the 4% roll-up. So we can see in year 7, that income benefit base is going to be based on that 4% roll-up. But then again in year 8, based on the 4% roll-up, right? That dotted line. But then look at this zoomed in portion, which this solid line is representing contract value based on the performance of the index allocations they did. We can see that solid line went above and beyond that guaranteed 4% roll-up. That is what we were going to use for the income benefit base, again, even after income is turned on. So in year 9, and using this chart as an example, the client would actually get an increase in the income they're getting. Okay. And once they get that increase, once that income steps up, that is now their new locked-in income number. Okay. Let's walk through a real quick case study. We've got Samantha, 65 years old, puts $100,000 into Peak 10. She elects not to buy the rider and decides to go with the guaranteed income solution, the free option. Okay. So in scenario 1, this is showing that immediate income scenario. So income benefit base is matching her premium, right? Because it's in the first year. So she has not gotten any contract credits to contract value or any of the 4% roll-up. But for example purposes, we're showing this immediate income scenario. So 100,000, we then multiply that by the withdrawal percentage or payout factor on this guaranteed income solution, creating that $4,000 income stream for the rest of Samantha's life. Scenario 2 is showing that 10-year deferral. So we can see her income benefit base grew to at least 140. We then multiply that by the withdrawal percentage at age 75. She's now 10 years older, of 4.5%, creating that guaranteed income stream of $6,300 for the rest of Samantha's life. One piece of feedback is that I've gotten on this option is the payout factors or withdrawal percentages seem a little low. And I do jokingly kind of respond with, well, it's free. So, if it wasn't free, then we can make the withdrawal percentages higher. But again, it's being positioned one of two ways: additive to accumulation. Should clients' needs and objectives change in retirement, they can turn on a guaranteed income stream from this option and not have to pay for it, as well as kind of that no-cost performance-based income solution. And I do want to share a quick sample quote on how it's kind of that no-cost performance-based option. So we've got a 60-year-old puts $500,000 into Peak 10. This is showing the guaranteed minimum. So based on a 0% return, except for what you're seeing 0.06% return here. That's because of the allocation I put in the fixed rate. So I did diversify here as well. But we see far right-hand column or second column from the right, this client's guaranteed to get an income stream of $24,000 for the rest of their life. Okay. But now let's look at based on the most recent 10-year performance of that same allocation I did on the accumulation illustration. So again, 60-year-old income at 65. We can see his income has already stepped up to $34,039. Again, at age 68, stepped up to $52,682. Once it steps up, that is now their new locked-in income number. It can only go up from there. But I always like looking at age 85, which we just assume is time of death. We can see under cumulative withdrawals, this client took a total a little over $2 million in cumulative withdrawals and was still able to pass on a $4.5 million death benefit. Leveraging what, up to about $6.5 million. If I put 100% in B&P, this would be between $8 and $8.5 million in cumulative benefit at age 85. So just dial the quotes back. But it's a really good option for clients that want that performance-based aspect, not have to pay for the income option, as well as leaving a legacy to beneficiaries. Okay. But now let's look at the rider. So the rider on Peak 10, which again, 85 to 90% of the business on Peak 10 is coming in with the bonus income plus rider. Okay. And what clients get here, day one is a 20% bonus. So if a client puts in $100,000, their income benefit base immediately becomes 120. And then they get a guaranteed 8% roll up for 10 years. Okay. But it's going to work the same way, right? We're going to take the higher of the two, just like we did on the free option. We'll take the higher of contract value based on the performance of the index allocation they did versus the guaranteed roll-up amount. Whichever's higher is what we use for that income benefit base, even after income is turned on. So again, using this chart as an example, let's say a client turns on income in year 2. We can see the income benefit base is based on that 8% roll-up. Again, in year 3, same thing, 8% roll-up. But then look in year 4. We see that solid line, which is indicating contract value went above and beyond the 8% roll-up. In that year, client would get an increase in the income they're getting. Again, in year 5, it goes above and beyond the 8% roll-up. So they're getting another increase in the income they're getting. And because of how well, with these participation rates, we are seeing substantial increases in income, even when they buy the rider. Okay, and I'll share kind of that income plus accumulation scenario you have with this rider on Peak 10. Real quick case study, we've got Darren, 65 years old. I'm going to jump through this very, very quickly. Scenario 1 showing that immediate income scenario. Scenario 2 is showing that 10-year deferral. I just want to point out, as far as the withdrawal percentages and kind of where Peak 10 shows up well on, if you're looking at like an Annuities Genius report or Annuity Rate Watch, if you're spreadsheeting the guaranteed income, Peak 10 is going to show up well for single annuitants, single income on shorter deferrals is where it's going to show up well. Kind of immediate income out to buy, a 5, 6, 7-year deferral. But then joint income, Peak 10 is going to be near the top in almost every scenario. And it's all because of these payout factors. You can see here, if we just look at ages 70 to 74, the single payout factor is 6.85%. The joint is 6.55%. Only a 30 basis point drop when we go from single to joint. Most income riders on index annuities drop by 50 to 100 basis points as far as the withdrawal percentage. Okay. So now I want to kind of go through the income plus accumulation scenario you have with Peak 10, which is different than nearly every other income product in the fixed index annuity space. So in this example, we've got a 60-year-old putting in $250,000, so 250,000 going in, turning on income at age 65. So a 5-year deferral. This is the guaranteed ledger. So worst case scenario, under lifetime withdrawals, second column from the right, this client's guaranteed to get at least $23,940 for the rest of their life. Okay. But now let's look at the most recent 10-year performance of that same allocation I did. 25% in the fixed, 25% in the S&P cap, and the remaining 50 in the index with BNP on an uncapped option. Now, client turns on income at 65. We can see that income option still matching that guarantee number of 23,940. But then look at age 66. That 2-year strategy with BNP matures, income steps up to 26,380. Again, at age 68, 2-year strategy matures, income steps up to 34,429. Just like the free option, once it steps up, that is their new locked-in income number. But now let's look out to age 85, again, which we just assume is time of death. This client was able to take a little over $1 million in cumulative withdrawals and was still able to pass on a $1.2 million death benefit. And it's all because of the participation rates and the caps that we offer on Peak 10 that you're not going to see anywhere else in the income market for fixed index annuities. You know, I can speak from experience for really every other income product in the market. Because of the low rates that they're getting, as well as the rider fees, they're going to, once they turn on income, they're going to see this contract value, which is also equaling the death benefit, hit zero anywhere between years 10 and 20. Usually right around year 16, 17 is kind of where contract value is going to hit zero. With Peak 10, you can see it's still growing. That's income plus accumulation. Okay. It's all because of the participation rates and the caps that you get with this product from Nationwide. The rider fee. So the cost for the rider for single income is 1%. For joint is 1.3%. Okay. So that's Peak 10. I do want to share some some sales ideas and also the healthcare cost assessment tool that you have access to with Nationwide. But first and foremost, some sales ideas that Peak 10 is a fit for that not a lot of other carriers still do in the annuity market. Partial Roth conversions. So Peak 10 is an option for partial Roth conversions. Non-qualified stretch. I don't know many other carriers. There's maybe 2 or 3 other carriers that will still do a non-qualified stretch. What that's referring to is what happens when a beneficiary inherits a non-qualified annuity, typically from a parent. Most of those beneficiaries believe that you have to just cash it in, pay taxes and cash it in. But what you can do with Nationwide is that beneficiary, that non-qualified annuity, can move that into Peak 10 and then they can stretch it, basically take life expectancy withdrawals to accomplish really 2 things. They're going to spread out that tax, as well as still should get some growth on that asset while they're stretching that contract over their life expectancy. Peak 10 is an option for both spousal and non-spousal inherited IRAs, which I've got slides in here, but for time purposes, I'm not going to go through that. But just know that we are an option even post Secure Act, and then income laddering. So I do want to share just how Peak 10 can be used to ladder income and how it benefits clients. So what Nationwide did, hopefully you can see this, but I kind of zoomed in here, but we rolled out a supplemental form for Peak 10 called the multi-contract form. Okay. And what clients can do with this, as the name of the form would indicate, is take out multiple contracts with one application to really accomplish one of 2 things. We use this for partial Roth conversions as well as income laddering. Okay. And, it's beneficial to do this income ladder because it's going to really give clients raises in retirement. Okay. And I'll go through an example here in the next slide. But, why would a client want to raise in retirement? Inflation, big topic right now. And then what gets more expensive as we get older? Our healthcare. Our healthcare costs only get more expensive as we get older and more sick, right? So this is a good option to help clients prepare for those rising healthcare costs. So let's walk through an example. We've got Mike, 60 years old, has $500,000, decides to take advantage of this multi-contract form with Nationwide and Peak 10 to execute on this income laddering strategy. So he basically takes 4 separate contracts for $125,000 each. Okay, and these payout factors, these are example. Peak 10s are higher than this. But just for example purposes, to make it kind of product agnostic as kind of an idea, we just decided to make up the payout factors. Okay. But so contract number 1, 125,000. He decides Mike turns to decide he adds the income rider to all 4 contracts, triggers that income in year 3, creating that $7,000 income stream for the rest of Mike's life. Contract number 2, he defers that one to year 5. He's getting an additional $8,300 for the rest of his life. Contract number 3 defers to year 8. Income from that contract's $10,200, right? Because he's getting more years of roll up and step ups in his payout factor. Contract number 4 waits to year 12, getting an income stream of $13,000 for the rest of his life. We can see here on the bottom, by laddering these contracts, he's getting almost $100,000 more in retirement than if he just purchased one contract and added the income rider to all of it, to that one contract. Huge benefit to, again, combat inflation and our rising healthcare costs. Okay. But I want to end and make sure there's time for questions with, I do want to touch on the Nationwide Retirement Institute and go through this sample healthcare cost assessment report. You as producers and agents and advisors, you get, because of your relationship with Capital, assuming you're appointed with Nationwide on either the life and long-term care or the annuity side you get access to the resources that we provide from the Nationwide Retirement Institute. Inside of this organization, inside of Nationwide, is really 3 teams. You've got the Advanced Consulting Group, fancy name for our advanced sales team. So this is our advanced sales team. They're broken out into different product lines on the financial services side. They're all JDs, tax experts, attorneys. They're really there for kind of those I've got a guy or gal situations, case consultation. But they do a lot of presenting, industry conferences, main stage presentations. And then, I'm going to skip over the middle image, but when we look at Insights and Solutions Field Team, this is where I want to focus because they're the ones administering this healthcare cost assessment presentations and seminars and this assessment. Okay. So this is a team of Nationwide employees that are going out and presenting to not only agents and advisors, but also end clients on really thought leadership type topics that are impacting the general public in retirement. On the bottom, these are the core 7 programs that they present on. We've got our program with healthcare costs, Social Security, long-term care, tax-efficient retirement income planning, women in retirement, Medicare, and health savings accounts. Okay. But what I love about this team and what they provide is not only do they go out and educate folks on these topics, but for the 2 programs on the left, which are really their flagship programs around healthcare and Social Security, they actually provide no-cost tools for you as an advisor and your clients to help guide these conversations. And I do want to touch on the healthcare cost assessment tool. So once you're appointed with Nationwide, you can pull this fact finder off our website, okay, to get a customized no-cost report created for your client, okay? And we can see here high-level medical questions, right? We're trying to get the most accurate assessment as we can. All the data and numbers that feed into these reports is all from it's a third-party largest actuarial firm in the world called Milliman. is what feeds this data. We do ask these high level medical questions just to get the most accurate assessment that we can. We don't want to get too invasive, but we want to ask something just so we're pretty accurate. And these reports are actually broken down by the county they live in, so we can see where they. We ask for an address because I live in Columbus, Ohio. I
Hey,
can
sir,
almost.
it's pretty.
What's that?
I think
So anyway, I live in Columbus, Ohio. I can almost guarantee my healthcare costs are different than someone living in New York, New York City, California, some of the more expensive states out there. So it does get that granular, and using this third-party actuarial firm, we actually estimate a county's healthcare costs to an 87% accuracy. Okay. And just to run through a real quick example, we've got Jim and Linda. So I want to show you the sample report. So based on how Jim and Linda completed the assessment, or I'm sorry, the fact finder, this is the data that we have. So we got Jim and Linda, both 60, both plan to retire at age 65. Looks like Jim's got a life expectancy for 15 more years, living to age 80. Linda's going to outlive him by 10 years to her age 90. We can kind of see why. Jim's got type 2 diabetes. Okay. So with this data, we can create this customized report for your clients. Okay. So on the left-hand side of this report, we see Jim's estimated out-of-pocket healthcare costs. So when he retires at age 65 in the year 2027, it's estimated he's going to pay $8,800 for that first year in retirement for his out-of-pocket healthcare costs. Linda, we can see $7,100. Okay. But when we look down the kind of left-hand side, down this bottom, well, really on the bottom, we can see their total out-of-pocket healthcare costs. So for Jim, his out-of-pocket healthcare cost is $232,000. We can see Linda, $424,000, bringing their household total to $656,000. Without Medicare Part B, we can see their total out-of-pocket healthcare cost is going to be $466,000. When that team or I are ever talking about or with advisors that are wanting to use this report, do you think we ever advise them to focus on these total out-of-pocket healthcare cost numbers? The answer is always no, right? Because if you show a client $500,000 of out-of-pocket healthcare costs in retirement, what are they going to do? They're going to throw up their hands. There's nothing I can do about that. So a few years ago, we added this average here on the bottom, which is a lot more digestible for a client. So we can see on the far right-hand side, without Medicare Part B, Jim and Linda are going to have an average out-of-pocket healthcare cost in retirement of just under $18,000. And I ask you, as an advisor, as a producer, everything you've seen today, can you think of a way to reposition an asset from like a 401k plan or an IRA brokerage account into something that will create a guaranteed income stream of $18,000? I can. It's peak 10, right? So, just keep this in mind as you're talking with clients. Everything I kind of shared today around income plus accumulation, the renewal rate integrity of Nationwide, it really goes beyond the spreadsheet. Too many times do we just kind of focus on that guaranteed income number. What does Annuity Rate Watch say? What does Annuity Genius say, right? Just keep this stuff in mind. Is we look back at kind of the income plus accumulation scenario you've got with peak 10. If peak 10's behind from a guaranteed income number of $500 a year, is it worth $40 a month to work with a carrier where you could, in a product where you could get increases in income, leave a death benefit to beneficiaries, not have to have those tough conversations around renewal rates? So, I'll go ahead and stop there.
I was just gonna say, I thought you did a great job covering everything and all the features, so it's very thorough.
All right, thank you. Have a good day.
You too.
Thanks.
Bye.
Bye.